Welcome to this week's episode of Startups for the Rest of Us. I'm Rob Walling. This week, I have a great conversation with Einar Volstedt. If you don't recall, Einar Volstedt is my co-founder with Tiny Seed, and he's also the founding partner of Discretion Capital, which is an advisory firm that advises SaaS founders who are in, let's say, the 1 to 2 million and up ARR range when they decide that they want to sell. And you need people who know what they're talking about, and Einar's one of them. And the fun part about our conversation today is we bat around funding for bootstrappers. And really specifically, there's been a couple conversations I've had over the past couple of months that have gotten me thinking about talking about this on the show, because obviously this funding has become much more viable for bootstrappers. It's not just bootstrap or venture path. There's this whole thing in the middle that we talk about. Tiny Seeds is obviously part of that. And I think there's still confusion and misconceptions, and it's just amorphous and often hard to understand what's going on and kind of some of the realities of it. And so we spend this whole episode batting around, hey, when should a bootstrapper think about raising funding? When should they not? When is it a good fit? And we talk a little bit about terms and how much founders should think about raising and just everything we're seeing. And the cool part is he and I have pretty different perspectives. I mean, I guess we share perspectives on a lot of things, being the co-founders of Tiny Seed, but I also have a lot of experience with other angel investments that I made before Tiny Seed that are still around, and I see different examples there. And he has experience with his Discretion work and even the companies that he started before Tiny Seed. So my hope is that it is helpful in just providing a little more of a level set and some more thoughts on this topic. So with that, let's dive into my conversation with Einar Volstedt. Einar, thanks for joining me once again on Startups for the Rest of Us.
Good to be on again, Rob.
Yeah, and we get to talk about funding and thinking through bootstrapping versus funding, or even these days, it's not just two options, right? It's not just, should I self-fund? Should I bootstrap? Should I raise venture? It's like there's all these avenues you can go down, whether it's a Tiny Seed like accelerator, raising a small angel round for a couple $100,000. To me, my take is it's gotten more robust and easier for founders who are in the microconf startups for the rest of us type community and that situation to raise money on terms that make sense to them. Because 10 years ago, I don't know of a single company in our space that could raise money not from essentially institutional folks who wanted them to become unicorns.
I mean, there's equity and there's different types of investments too now. That wasn't a thing like 5 years ago, like things like non-dilutive revenue-based financing, PIPE, that sort of thing.
Yeah, a lot of options. I know when I did, my microconf talk in Vegas, it was US growth, maybe it was 2018, where I said, it might have been 19. I can't, who can keep track with COVID? It's just everything before COVID and everything after. But I did a talk and I was kind of like talking about the state of bootstrapping and how I saw more companies raising funding, not to go venture track, but to raise one round, maybe two and 200 to 500,000. I pointed out customer.io. I'm an angel investor in Churnbuster, Right Message, CartHook, LeadFuse, all of these folks who were like, yeah, we're not looking at IPO. We're not going the full way. And as I saw that happening, obviously Tiny Seed came out of a need where it's like, well, I only had so much of my own money to be able to put that in. We did Tiny Seed because there was a need on that side. It was pretty obvious to me that more kind of bootstrap-ish, capital efficient founders want to raise money these days.
I think so. I mean, one of the missions, like for me, the reason why I love doing Tiny Seed is because I think that kind of an investment in that kind of founder really enables them to quit their day job and really, like, there can be many more founders like that if you have the capital going to these kinds of places.
Yeah. And I mean, I want to be clear, obviously startups, the rest of us, 500 and whatever, we're almost to 560 now. Like we've talked a lot about bootstrapping, but we've also talked about funding. Even going back to like 2013, 2014, I talked about fund strapping with Colin from customer.io. Mike Tabor, the co-host emeritus of Startups, the rest of us, and I had several episodes on when to think about taking angel investment, on funding versus bootstrapping, 19 questions to ask. That was episode 411 back in 2018. So it's not right for everyone, and I think that's one thing we want to talk through today is like, when does it make sense? We've seen founders, I'm going to be honest, I don't know that you and I have ever talked about this, but like I've seen founders who I thought would just be bootstrappers forever and never raise rounds, take funding. And they have very good reasons for it, and they don't regret it. And it's folks like Craig Hewitt with Castos. He was in Tiny Seed Batch 1. I just thought he was going to bootstrap everything. Ruben Gomez with BidSketch and now DocSketch Signwell took money from us, and he did it to move faster. He did it because it makes some things just a little easier, and it hasn't changed his business other than having more resources to work with?
Yeah, I mean, I think you mentioned Colin too. Like he's doing incredibly well now. I think he's open about his numbers. I think he's doing 22 million ARR right now.
But when you talk to him, he's totally along that line too of like, hey, I don't want to be a unicorn. I want to build a real business, 22 million ARR SaaS company in the email space. And now I think they're doing a crowdfunding, or I know they're doing a crowdfunding thing right now to raise money. And I believe they've raised like 2 smaller rounds before that. I think the very first round was a couple $100,000. And I don't know what the second round was, but I think it's probably all in Crunchbase. But you're right. It's founders like that who see it. There's bootstrapping, there's VC, and then there's this whole thing in the middle now. And that's what we're it's still amorphous, I think. That's what we're leaning into, obviously, with Tiny Seed. So I think that's a good lead in actually to the first, we're going to cover some topics like why raise if you want to. And again, this podcast is not becoming a thing about raising funding, or if you don't raise funding, you're not in the club. It's nothing like that. It's just another tool in the tool belt, right? It's another option, revenue-based financing, this type of funding, whatever, to help you get there faster, which has really been the mission of Microconf Startups for the Rest of Us, all my writings from day one. It's like, how can we help more entrepreneurs succeed, more founders become self-sustaining? And this is another option. So I may have mentioned a few of them already, but when you see founders raising these small amounts of money, let's say through Tiny Seed or through doing other angel rounds, like when is that a good call? When should they think about that? And how are they using the money to essentially accelerate their business in the best case?
Yeah, I mean, I think when we first started, one of the main ways that I thought about it would be for Tiny Seed founders would be people who sort of had enough, had some kind of revenue coming in, but it wasn't really enough to make it like their main focus. And I still think there's a good chunk of the founders that we back that are like that, where it's like they're at 3,000, 8,000 MRR, something like that. And particularly if you're 8,000 MRR, 2 founders, you're probably not self-sustaining at that point. And like, I think taking money in order to effectively pay yourself and say, okay, I'm not going to burn through all my life savings or, remortgage my house to take this risk. I want basically to offload that risk to someone else who has a higher risk appetite, than me. I think that's one of the better reasons to do it. But I also think like one of the most surprising things is how many people are at the point where like they could probably, they don't use the money that we give them to pay themselves, but they use it potentially to accelerate the sort of channels that are already working, or feel like this gives them the leeway to just be a little bit more experimental with the kind of growth channels they can go after. So like if you're totally bootstrapped and you're like basically just about self-sustaining, how keen are you going to be like, all right, I'm going to hire like an SDR service and run that for 3 months for 15 grand and then, potentially hire like a salesperson and try that channel out, or, re-up, start a Google ad campaign to try out this new channel. Like I said, I think it offloads some risk and it enables the founder to take more risks and potentially grow their business substantially faster.
Yeah. And see, I like that thing about offloading risk because there's been several founders who I know who have taken money, like Derek Reimer is an example, right? After the Drip acquisition, he has enough money that he could basically angel fund himself, right? But he took Tiny Seed money back in batch 1. And when I talked to him about it, like, why did you do that? Because you have that much money plus some in the bank. And he said, it takes some risk off the table. Like, it's more runway, but it's also less of my personal risk. And I don't give up control. It's just not a huge loss except for a few points of equity in essence, which I figure, hey, if it's successful, that's probably not going to matter in the end.
Sure, absolutely.
Yeah, I like that idea, that thought of like taking some risk off the founder, because bootstrapping, like true bootstrapping, as you said, there's a ton of risk on you personally, and it can be stressful.
It can be stressful. And I also think like it is a certain level of privilege to be able to bootstrap a lot of the time. It means that you have either a bunch of savings, you made a ton of money doing something else, or a lot of the time your spouse makes enough money so that they can cover the whole, household. And I think just enabling this kind of funding means that more people who necessarily aren't already in that situation can take the risk that's just inherent in starting something like a software business.
Yeah, that makes sense. So from my end, like the folks that I see raising and doing well with the money, they want it to move faster. They want it to decrease risk, as you've said. And usually, not every time, they want it to make a key hire that they can't afford, especially these days with, a lot of big companies remote now. Talent is more expensive than it used to be. And so I think the main hires, and correct me if you've seen other situations, but the main hires I've seen are to hire like a marketer, somebody to kind of run demand gen, or an agency to do the marketing. And the other one is like more development talent, like a senior developer who can technically lead so that the founder can maybe step away. Or if it's a non-technical founder, that they have, that person now who's running the show. I think those are the two big ones I've seen.
Yeah, I think it's sort of telling how different our approach is, like the founders that we talk to, because that's not what I see.
Yeah. What do you see? No, that's why you're on here, right?
Yeah, I see people mostly hiring like a customer success type person just to take like customer support load off either key engineers or the founders. And then I see people hiring sales. Like, they're trying to like either just SDRs in order to fill more of the funnel for the founder to do the close, or for the founder to sort of say, okay, I'm ready for an account exec who can do demos, so I don't spend all my time doing demos. So I see a bunch of those things too, where it's like, yeah, they would have gotten there to where they needed to hire, say, a customer support or another salespeople, but maybe that would take another 18 months. And like just the fact that they can hire now just means the business moves faster.
And I think to look at it from the opposite side, like what are the scenarios or the situations where a Bootstrap founder probably shouldn't raise, probably should think about just continuing to bootstrap? And I'll throw one out right from the start. My sentiment is that if you don't have or are pretty dang close to product market fit, meaning that you've built something people want and are willing to pay for, that I think you should keep grinding until you get really close to that. Now, I'm not saying you have to have a sustainable marketing channel and a bunch of leads coming in and a whole built out funnel. That'd be great. It gives you a better valuation. It makes more investors interested. But if you're at 2K MRR and you're getting onesie, twosie people coming in and some people are churning and you're just it's an early product still, my sentiment is that's not something I'm personally interested in investing in. And I don't know a lot of investors who are willing to bet that early. Do you agree or disagree?
I think there are a lot of investors looking to bet that early, I think. But they're more like, your story has to be different. So if anything, I actually think it's easier to raise money when you have no revenue if you have a good story.
In SaaS? I don't think in B2B SaaS.
Well, yeah, but even so, it's like, we're going to do this thing where it's just like, if you're 6 months in and you have a 20% monthly churn that people can look at, it's hard to explain. The difference, I think, is if you're going to go to market and try to raise with, no revenue and just like a plan or a vision and stuff, that plan and vision has to be much larger, because the kind of investor who are like interested in investing at, say, 12 million pre, without a product and just 2 or 3 engineers, because the risk is now so high, it needs to be something that they believe can be a unicorn. So you're sort of in the unicorn territory. Like if your story isn't up and to the right, they're going to be like, nah. We see a lot of pitches for people who haven't proven anything yet, and so they really have to believe and be excited about the story in a way that, like, if you're doing 8,000 MRR and you're growing 10-15% month over month with no churn, that's a very different thing for people to invest in.
Yeah. So I don't know any investors, and I have, I'm friends with 12, 15 angel investors. These are all former founders or like people I met through MicroConf and stuff. I don't know anyone who'll invest in a SaaS app pre-revenue. There's a couple.
I'm in the valley, so I know lots.
Yeah, see, I think that's the difference, right? Is you
keep telling me like, hey, let's talk. So yeah, I know tons of people who will do that. But again, like, it has to be big vision.
It has to be a venture scale business, right?
Venture scale, IPO, take over the world, change this. Now those kind of investors typically will. And if anything, I do think it's sometimes easier to sort of sell the dream rather than trying to explain the numbers in this regard.
I would agree with that. And I will just say, and you and I, by the way, don't agree on everything. So that's like on this podcast. I mean, that's why you're here. Otherwise, I could monologue this whole thing, right? And just do a Rob solo adventure.
Yeah, we just talk about marketing hires and things like that. Nobody's talking to me about marketing hires
for
ever.
You. Yeah. And when I'm talking to them, it's like, don't talk to Rob if you're going to do a sales hire. Talk to Einar, right? So yeah, my take is like with B2B SaaS, if you want to build a 10, 20, $30 million business, if you have a really good network, and let's say you're a second-time founder, right? You're a Josh Pickford, you're a Derek Reimer, you're whatever, anybody, Rand Fishkin. Can you raise pre-revenue? David Cancel, right on his 5th one. I don't remember how much he raised, but he raised like $5 million at a $15 or $20 million valuation with just an idea, because it's David Cancel, right? But most of us aren't that person, right? Most of us are doing this for the first time. If you don't have a strong network or some type of and you'd want to build a B2B SaaS company, 10, 20, 30 million, I have not seen someone be able to raise around at that point, pre-revenue.
I also think crucially, the thing to think about is like, I do think you can raise, like I said, I know several investors who want to do this. Like you can raise with just an idea or a deck or just a team or whatever, but then the vision has to be big. And that does usually exclude you or preclude you from actually doing the kind of exit where like at 20 or 50 million bucks, because just the mechanics of the way that investments are being made in that case with liquidation preferences, valuations and all this stuff means, and like, rights to investors to block things and things like that, you'll end up in a situation where, like you have to really go for like 100, $500 billion exit or nothing. Like there is very little middle ground there.
So another, I'll say a type of business that I think should probably not raise is a step one business. If we think about the stair-step approach, step one businesses are usually oftentimes built on a platform like a Shopify add-on, a Heroku add-on, a WordPress plugin. And usually they plateau at some point that is far below what any investor, even bootstrap friendly investors, want. Right. And there's platform risk too, that, hey, you build something big enough, Shopify comes a knocking and bad things happen. Right. And you build something big enough and, I don't know, Heroku hasn't done this as far as I know, but any platform can kill you or just say, hey, pay us 20, 30% of your revenue all of a sudden.
Yeah, that's true. I do see sort of breakout businesses on both who build on platforms. Like, that does happen, but I certainly think the risk is higher. And I think investors will be more like, well, what happens here if, they build this in-house or cut you off in some way, shape, or form?
Yeah. And we, being Tiny Seed, have invested in at least one, and I'd say, a few businesses that have platform risk, including Rails Autoscale. Adam was on the podcast just a few weeks ago. And that was a conversation we had early on was, hey, how does this scale? Because, can Rails Autoscale be a $5 or $10 million ARR business as it stands now? Personally, I'm pretty skeptical. And Adam is too, that the space maybe just isn't that large. And so then we said, well, how do you reduce platform risk and how do you get to X million in revenue, right? And you, as long as a founder is thinking about that, then at least there's room to grow there. I think there's been other questions. Someone asked me on Twitter, maybe it was like 8 or 9 months ago, like, why is there no Tiny Seed for info products? Or course creators like makers. And it was an honest question. I appreciated it. And I answered it and basically said, because they don't scale like SaaS, because they're often reliant on a single individual, not all the time, but often reliant on a personality or a personal brand, and the exit multiples aren't there, right? I mean, that's a part of why this works, is that SaaS sells for such a crazy high multiple. Not that everyone has to sell, but that is one driver of returns. I think another time when founders should probably not raise money is if they want the true 4-hour work week lifestyle business. They want to work part-time. I mean, I did this, right? I did this for a couple of years with Hittail. It was great. Work 12 hours a week. And it's like, it's not that suddenly investors are your boss, because that's not how it is. I think bootstrappers think investors are probably a lot more involved than they think they are, or like managing their time, or like send me your time clock. And that's not, your timesheet. That's not how it is. But I do think if you want to work 10 or 15 hours a week, go bootstrap an amazing business and make it a lifestyle. And I've had several of those, but I think the moment you think about, hey, I'm going to take out someone's, external funding from someone else, to me, it's kind of a commitment to like, no, I'm going to grow this, and I'm going to be committed to this business full time. I'm not going to go start other side projects during this time. Not that you can't do anything. I mean, you could sell a blog, a podcast or whatever, but if I invested in a founder personally and they were doing a SaaS app and suddenly they started another, like a little side project SaaS app, I would have a conversation with them about, what's the plan there? Do you plan to focus, or do you plan to split time, or, what's the deal? Do you agree with that, or what do you think?
Yeah. Or is this a pivot? I don't know.
Yeah.
Like there's also issues like most investors come along, there'll be IP assignments and stuff in the company. So if you start a company and then you work on this product and then you start a side business, now is your investor part owner in the side business too? Is that a pivot? What is it? There's certain things to think about there. But I think you're right. I mean, like running a B2B SaaS business was what most of the time we're talking about. Like it's a full-time job. If you're planning to run most of the time, if you're just planning to do 4-hour work week, then I probably would look at like info products or, some of the more, smaller scale.
And step one plays are great. I mean, when I think about, I did this with Hittail, right? But Hittail was like a single feature almost, it was like, it had multiple screens, but it was not the plays that we're talking about. And it really it was SEO. It was an SEO keyword tool. And I just had a couple channels that worked mostly on autopilot, didn't have to do sales. It was self-service. Churn was high because the price points were low, but that didn't matter. I got up to 25, 30K a month. great lifestyle business. You know what I mean? But that would have been dumb for me to then go out and say, I'm going to take investment for this, unless I wanted to then double down to be like, look, I'm going to make this into an SEO suite or a rank track. You know, there's things that could expand the market, but I personally wasn't interested in doing that in that space. And so,
yeah, I mean, and it's also like, in some cases, like it makes sense to go after the bigger thing after a while. Like, you know, I still remember when PagerDuty launched. I was like, PagerDuty? Like, what? Is this a business? What the hell?
Yeah.
And now they're a publicly listed company. You know, I'm like, okay, I was wrong. So sometimes there are, you know, things are bigger than you think. I think a lot of the time, as early stage investors, it's, despite what some investors will tell you, I think it's almost impossible to really, really have a good sense of like what's going to really work. There's just a lot of randomness and luck and things in there that accounts for a lot of it.
Yeah. When I think of funding options for bootstrappers these days, obviously, you know, there's accelerator like Tiny Seed. There are other funds that do similar stuff. See, I don't know. I mean, I've heard of like the Weekend Fund, which is from Ryan Hoover, who's the Product Hunt founder. I don't know if they're bootstrapper friendly or if they're kind of venture only. And I think that's a conversation to have with folks. If you're going to take funding, to be like, hey, I would sell if I got an offer for 20 million, right? To be upfront about that. And if the investor doesn't want to invest, then I don't think you should take the money, because you're going to have this conflict now when you get that offer for 20 million that's going to change your life and you push back on it. And the investor's going to say, no, 100 million or a billion or bust, right? It's like you have to be on the same page. And there are investors out there, I know angel investors, who are willing to take that 3x, 5x, 10x versus the kind of unicorn play.
Yeah, and I think this sort of boils down to a trade-off in terms of valuation that you take too. You know, like I think particularly this more traditional Silicon Valley stuff, it's always like the higher valuation you can raise at, the better. It's like, oh, look at us. We raised a $20 million pre or $12 million pre. It's like, if you raise a $12 million pre and you sell for 20 million, even if you have the right to do so and you do it, your investor is not going to be happy. That's not what they wanted. That's pretty much a fail for people. And just because of the economics of how the investors, the investors and their investors operate. So that's the trade-off really when it comes to like, what optionality are you taking off the table by taking a super high valuation and raising a ton of money?
Yeah, and that's a really good point, is that most of the more bootstrapper friendly funding sources that I'm familiar with, the valuations are lower than if you went to Sand Hill Road in Silicon Valley and it's two people in a garage with two laptops and they have a product and they can get a whatever $5 or $10 million. I think coming out of YC, everybody don't get a $10 million thing whether they've launched or not, which is just crazy.
So honestly, like the last I heard now, pre-product launch on demo day, it's like 12 to 20 million pre.
That's insane.
But here's the thing, what has changed, I think, in the last 10 years, and I've been in the Valley, is it used to be, I mean, because of the dark days of like 2008, 2009, and like almost nobody was investing, which has turned out to have been the best time to be investing in things like Airbnb and Dropbox and things. But fundamentally, I think what has changed is, and I think this is kind of debilitating for founders who are struggling with this, because you read all these stories about, oh, there's so much money in this space now. It's like you should go out and raise money right now because there's never been more money in the ecosystem. And if you look at the inflows into venture, that's true. There's a ton of money going in, but they tend to go after fewer and fewer deals. And so you end up with this very binary outcome where it's like either you're super hot to the point where like, venture capital associates are like cold calling you on a Friday night, or there's crickets, like there's nothing. And that's very, very tricky to deal with. Like, particularly if you're trying to raise money and you're in the crickets camp, and then you read all these stories about like, oh, it's the easiest time ever to raise money. I'm like, well, it's the easiest time to raise money for a particular kind of company and opportunity and founder. Like, and if you don't want to do that, or it's not what you're after, then it can be very hard. Yeah,
I think that's a really good point to think about. Okay, so let's say today, Einar, you had a B2B SaaS app doing $5,000 to $100,000 a month in MRR, and you decided that you did want to raise that round. Obviously, I would love if you'd come to tinyseed.com and your email address. We are now having open applications. We're now running 2 batches per year. And so every 6 months, we open applications. When we'd love to chat. And we even have a mid-batch application if you're doing anything north of 5,000 MRR. And we have, those coming through and we're having conversations so we can fund people as it makes sense, for their journey. But let's say you were doing 10, 20K MRR and you decided for whatever reason that you didn't want to go through a program like Tiny Seed and you were going to raise it on your own and you want to raise $250,000. In my head, you got to work your network, right? And if you don't have one, I'm not sure what to do. And that's actually, when I thought about raising, let's say 6-7 years ago, I was just like, I don't know who I will talk to, who will give me money. But I would then look at using, like a convertible note or a safe. And people can Google, we were not going to define them here, but they're a way to not actually, you don't have to do a priced round now and get stuff on your cap table. And that can take more time. There's more due diligence in that. But a convertible note or safe is a promise of essentially future equity to investors. Is that the approach you would take?
I think probably so. I mean, I'm more pro selling equity too. I think that's fine. As long as sort of the problem with selling equity is a lot of the time it ends up, so most investors, and people don't know this either, most investors, and this is not true for us, will make the founders pay for their legal fees. So part of the reason why safes and convertible notes took off and things is because it's cheaper on the legal front. And that is sort of doubly valuable because most of the time, traditionally at least, investors have been like, yeah, I'm going to, have you pay for my lawyer. So if you're taking $250 and it becomes a protracted back and forth with legal reviews on either side, you could easily be in a position where you got a $250,000 investment, but now $50,000 of that is in legal fees for you and the investor that you both have to pay out of that $250,000. But if you can, deal with someone who can very effectively and efficiently do a priced round, then I don't think there's a huge downside to that.
That's what we do, and we do it efficiently, right?
Yeah, it is fun. And there's some tax benefits and there's some clarity there, I think, a lot of the time in terms of who owns what. It's less of an issue with more like the kind of Tiny Seed type companies or Bootstrap type companies where you're not doing fundraising every 18 months. But some of the challenge with the safe notes and the convertible notes and things is if you do multiple rounds of this and one after the other and some bridge stuff in there, it actually becomes quite difficult after a while to figure out how much your company is left because they convert at different caps and at different times and different triggers and all that stuff. So there is something to be said for this other cleanliness to say, okay, well, I'm buying equity and we're valuing your company and we think it's worth 2-3 million and we'll buy 10% for whatever. I do think there's a niceness to that. But the challenge is particularly if you run into unsophisticated investors or maybe investors who are used to larger rounds or later stage stuff, you can get stuck and blow easily $50,000 in legal fees, which is obviously counterproductive for a $250,000 round.
Right. To untangle that. And I guess my advice there is don't raise a bunch of different caps and valuations. Keep it simple.
Yeah, well, that's the problem for people. This is the thing. If you're going the more traditional venture route, then what are you raising money? You raise money, so you burn hard, and then you burn hard, and then you're running out of money, and you got to raise more money so you can keep burning hard. So
right.
There are people with 13 safes, and they're is there someone with software that can help me figure out, or an analyst that can help me figure out how much the company's left?
Yeah, don't do that. I mean, if you're a bootstrapper, you're not going to be raising all the time. My advice would be not to do that. As a bootstrapper, you don't need to be raising all the time, and it's a distraction, and you're not on the venture treadmill where you need to raise every 18 months. So I would chill out a little bit with it, keep it simpler. One last note on safes and convertible notes is that if you truly are thinking, hey, maybe this might be my only round, then you're essentially committing to giving equity in the future, usually at the next funding round, or if there's an acquisition, right? So if you do plan to run the company, you want to run it for 10 or 20 years and take out profit, safe and convertible note. This is not legal advice. We're not lawyers. That's a disclosure, but it's not the best. I mean, it can screw investors, to be honest. There's actually, it's TopTal, I believe, where they raised money on safe's convertible notes. They never raised another round. They haven't sold. And so all the investors don't technically own the equity. And the founder can actually literally legally take money out of the company and put it in his own pocket, or him or the other founders, I guess, whoever owns the equity. So it's a weird situation. And I think if you are thinking about doing it longer term, then equity, it's probably makes a bit more sense to think about that. The other thing is there was a pre-Tiny Seed, did an angel investment, it's wound up working out very well, but the founder used convertible notes. And at a certain point, he just said, all right, we're just converting to equity at this rate. We're just converting at the cap or something like that. He just decided he wanted everyone on the cap table. He wanted to clean it up. And he didn't want to keep his interest involved in this and that. And it was just a decision as the founder he made to simplify everything. So founder thinking about raising money, what do you think the dollar amounts where should they land? I guess should is a strong word, but there's a minimum that makes sense, right? It's like I don't think you should go try to raise a $75,000 round because the time and the legal fees alone are not worth it. And then what's, on the top end, I think, what are your thoughts on small and large?
I mean, I think anything less than, it's a little different if you're just taking like, a pre-specified money from us or YC or whatever, then it's like, okay, it's 120, 180, 200, whatever. But I think in general, if you're going to raise money, it's probably worth raising at least 150, 200,000, I would say. At least that's true, I think, in the US. And I think it's hard. Like, it becomes one of those things is like, if you can't raise that much, is it really worth the pain and going through and having investors and like at 75,000? Like, so like, as an example of like just cost and things is like, if you were to do a special purpose vehicle, so this is one of the ways that you can put a bunch of people on a single line item on your cap table. Like AngelList will do that for the investor on the investor side, but it's going to cost, $8,000 to do, which is actually reasonably cheap. But if you're raising $75,000, that's a material part of the actual investment that comes through. And this is, pretty significant dilution for the investors to take. So I do think that there becomes a stage where it's like, this doesn't make any sense. And I think that's probably about 150, 200,000, something like that.
Right. And we should point out that accelerator like Tiny Seed is different than that. I mean, most founders who get funded by us, I'd say the vast majority is 120,000 to about 250 is the general range. But since our process, we fund 20 companies at once and we fund the entire round, this is very different than you going and trying to find 4 investors at 25K each and then trying to close a round. That legal cost there'll be a bunch of costs on you and more complexity trying to wrangle them than in dealing with a fund like Tiny Seed.
Yeah, I think that's true. I mean, like, it's just much more efficient for us. It's like, and we pay our own legal fees. So we're sort of incentivized to make it an efficient process instead of something that just drags on and on.
Right. And then AngelList has an RUV, a roll-up vehicle, which I don't know so much about it, but I think the idea is it's like a no-fee RUV, and it's to help with convertible notes and safes and stuff. But I think it's pretty new. Have you heard about this?
Yeah, it's not entirely clear to me. I should probably look at how it's different to an SPV. So at AngelList, the SPV fees are about $8,000. RUVs, I think, are sort of similar to that. Like, it's certainly the same deal. It's like the reason why you would have an SPV is because you want to be able to say, okay, there's 25 people who want to throw in, $10,000 each, but I don't want 25 people on my cap table for assorted reasons. So you put together an SPV, and then the SPV is the one that invests. And I think a roll-up vehicle is sort of the same. So it's not entirely clear to me how they're technically different.
Well, here's one thing about RUV is they basically say you have to be a US C Corp in order to do it. So that's going to cut out a lot of folks. Bootstrappers who want to stay LLCs or want to be incorporated in a different state. But they basically say if you're raising a SAFE, an equity round, you're likely eligible for a no-fee RUV and with zero carry for investors. But again, I haven't dug into it to know how that all works, right? And how AngelList makes the money, or if they're just doing it out of the kindness of their heart. You think that's the reason? I don't think that. Not that AngelList is bad. It's just their business, right? They have to make money on this stuff somewhere. So cool. Yeah. So in my head, I agree with you. I think 150 to 500,000 are the most common. That's the most common range that I've seen across. Well, we have 41 Tiny Seed investments, and I have 18 between Sherry and I, 18 private angel investments, pretty much made before Tiny Seed. So that's almost 60 companies, and that has by far been the range, 150 up to 500. There's obviously exceptions, and there's people who go have a really great network, and they're a second-time founder, and they can go out and raise $600,000 in their first round. But that's pretty, it's been pretty unusual in my experience.
Yeah, I think that's true. I mean, there are people who do it, and it's just a matter of like what are you trying to do with it? Like, what are the trade-offs in terms of optionality, and like what because like if you raise $2 or $3 million, then investors expect you to spend it. It's not like we don't expect you to spend it. In some cases, we have to tell founders like, hey, why are you not doing this? It's like, oh, this seems expensive. It's like, well, we gave you money. You should spend it. That seems like a good use of the money. But that's even more pronounced if you're raising $2 or $3 million. Like if you're raising $2 or $3 million, then investors will not be pleased if 12 months later there's $2 or $3 million in your account, unless that's because you've been growing like crazy.
Yeah. And I think with that in mind, I mean, and the idea is the more you raise, the more of your company you have to sell, right? And that all depends on valuation as well. And valuation is really set by the market, but the market looks at what's your traction, oftentimes what's your MRR, what's the story you're telling, right? What's the certainty that people think that you are gonna be able to provide a return, whether that return, and we'll get into it in a second, is an exit down the line, or it's taking profit out of the business, which is, if you say, I'm going to be an LLC and I want to take profit out of the business and run this for 10 or 20 years, you will significantly reduce the pool of investors who are willing to invest in you. And I'm not saying that's a good or a bad thing, but just realize that there are far more investors who want you to exit, right?
I think fundamentally one of the things there is like, if that's your goal, if your goal is to keep it forever and then, pull cash out and distribute cash over time, then honestly, like what you should be looking at is more likely things like revenue-based financing, because the investors who are looking for more dependable cash flows are more likely to be putting their money into those kind of vehicles. Equity type investors typically are looking for higher potential upside than what comes from just profit distributions. And the fact that with revenue-based financing type things, it's a little bit more determined like how this has to work. And it's a bit more predictable in terms of the cash flows that the investors can sort of expect, versus like if you're taking an equity investment and you're saying like, oh, I'm just going to pull profit out and distribute it over time. Effectively what you're saying to the investors is, trust me, I'll do that. Like, don't worry, I'll do it. But like, if you take more revenue-based financing, like you're entering into a legal contract to do it. So the incentives are slightly different there. Now, the problem, of course, is the stage we invest, like super, super early, the earliest stage. It's almost impossible to get revenue-based financing because your revenue is so low.
Right. And I think at the stage we invest, which is early, a lot of founders don't know. They don't know if longer term they want to run it and pull profits off. They don't know if they get an offer for 5 or 10 million. When you see that number on a check or in an email, it changes your perspective. I tell you what, you suddenly realize, wait a minute. So let me get this straight. I can pay my house off. I can fund all my kids' college funds, and I could feasibly never have to work again or never have to work in anything I don't want to again. That changes your whole outlook on life overnight. And so, or they may want to go raise a venture round later. And that's where I think something like Tiny Seed comes in. That's one of the reasons we started it, is we wanted folks to have that option, right? To be able to buy themselves some time to build the business to the point where it becomes maybe a little more obvious of where it should go, in the direction the founder wants to take it.
Yeah. And that can work out different ways too. Like we have founders who, tell us that like, if I got $10 million, I'd sell it. And then now they're like doing very well. And they're like, no way would I sell for $10 million. So it goes both ways. It's just nice to have that optionality, I think. And like we do have founders who are like, this is a bigger opportunity. I just want to go and raise, a ton of money and go the venture track. It's like, great. Do that.
And that's the fun part. I mean, that's what I like about it. Like, anyone who's known me or listened or read or just been involved in any of the content I've been putting out for 15, 16 years now knows that like bottom line mission for me is to help more founders succeed faster and get to having a sustainable business, right? Of any kind. And a sustainable business may mean that, hey, they are able to, sell it for millions or tens of millions, or enough money that maybe their life-changing money is $500,000 because that changes their life in the short term, and then they're able to go start another business. But that's why I love doing this podcast. And that's why I love being part of MicroConf, because that community is folks trying to help each other. And that's why Tiny Seed is such a part of the mission, and why it was so cool that you and I essentially agreed on that this needs to exist in the world. I mean, in 2018, as we were talking about this and figuring out, should we start Tiny Seed? Does it work? I knew there was desire on the founder side because of all the people that I had invested in, and was kind of like, all right, I'm out of money in terms of, writing more checks to startups. I need to keep my allocations between Bitcoin and Ether and public equities and all that reasonable. But what I didn't know is, would investors, in essence, be willing to invest in this asset class? And that's been that other side of the marketplace came together pretty quickly, which has been nice.
Yeah, and I think we started seeing that on the buyout side too, with Discretion Capital. We started seeing that like 5-10 years ago, certainly 10 years ago, but even 5 years ago, it's like if you had a 2-3 million ARR B2B SaaS business growing reasonably well, but clearly not going to be the next Airbnb, there wasn't a lot of interest, from on the buy side, versus that has really changed on the buy side as well. So that makes it more feasible to basically get money from investors who want to come in at the early stage there. Yeah, because it's a potential exit market, and it's just they see that it's like, people are selling for 4, 5, 6, 7, 8, 9, 10 times ARR at 2-3 million, and that becomes a viable thing to back at that point.
Right. That's what's good today is if you are building SaaS, it's so capital efficient. It is can be extremely profitable if you decide to keep it. It can be extremely lucrative if you decide to sell it. And if you gain traction, there is money out there. Whether it's, you and I've talked a lot about TinySeed here, but we've talked about pipe.com, revenue-based financing, and there's a whole word. Just type in RBF or revenue-based financing into Google and you'll see 20, 30 players in there. There's a lot of options out there. And then there are, again, other funds, that are thinking about this stuff. And I just think we live at such an amazing time. If you want to bootstrap, awesome, do that. That's what I did with all my SaaS apps. But you know what, dude? Like one of the reasons I started TinySeed is I wanted this fund to exist for me. Because during the drip years, we needed money and we were doing all types of crazy stuff to cut costs. And it was super stressful. And I wanted to really quickly raise a couple $100,000 is what it would have been a big difference. But it was like, I just don't have the time to do it. And I don't know if I have the network, which in retrospect, I probably did. But I don't know, there was all this indecision around it. And I think almost destigmatizing or perhaps normalizing it just a bit more, I think is helpful, in the space.
I think so. And it's just I just want to back more founders. I think more people should be doing their own thing wherever they're based in the world, rather than, feeling like they got to, like the pinnacle is to go work for Google or something in Mountain View.
Yeah, I think that makes a lot of sense. Well, sir, I think we've covered this pretty well. If folks want to keep up with you, you are Einar Vollset on Twitter. It's EINAR VOLLSET. And of course, they can keep up with us at tinyseed.com if they want to hear more about it. Or you blog prodigiously on your .com, don't you? Do you have one blog post in the past year?
On einarvollset.com? Yeah.
Yep.
It's a table that shows IRR versus multiple over time.
Oh, amazing. Yeah.
I know.
Says the guy, I'm shaming you. And I mean, the last time I blogged was probably 2 or 3 years ago. So
well, at least you put things out. I was thinking about this. I was like, yeah, if you follow me on Twitter, you're mostly going to see me complaining about the Giants.
Right.
Like I said, I'm not the marketing guy side of things here. I'm more the background dude.
And you are headed to the UK. You're actually going to be in or around London for 2-3 weeks? 4 weeks here soon?
4 weeks. We'll be there through the end of the summer and then come back for the kids' school start here. And then I'm probably going to be in and around Europe and London throughout the fall, really.
Yep. And so part of the reason you're there is personal, but part of the reason is because we are raising a European TinySeed fund. And so if you're an investor, whether you live in Europe or whether you just want to have exposure to that, essentially that asset of early stage B2B SaaS located, somewhere in the EU, Europe area, they should reach out to you. They should go to tinyseed.com/invest. And there's a few questions there and that pings you directly and you'll be able to meet in person because you're fully vaccinated. That is super cool. Awesome. Thanks again for joining me, man.
Thank you.
Thanks again for joining me this week. A lot of good ratings, 5-star ratings are rolling. It's been super cool. I think we're approaching 920 worldwide ratings, and I want to get to 4 figures. So if you haven't given us a rating or a review, I'd appreciate either or both. We received this great review from Gilmore Golf from the UK, 5-star, refreshingly honest and relevant. I'm a fairly new listener who's now working their way through the back catalog of episodes, but I wanted to leave this review to thank Rob for all the value, insight, and education he shares for free. I now have a renewed energy and inspiration to pursue my entrepreneurial ideas without compromising on the most important things to me. In other words, my family. Thank you, Rob, and please keep going. So thanks again. This is the kind of stuff that makes me want to keep going and makes the whole team behind Startups for the Rest of Us make us want to keep going. So thanks, Gilmore Golf. And if you haven't left a rating or review, I'd really appreciate it. And that wraps us up for the week. And we'll be back in your earbuds again next Tuesday morning.